Welcome back to Prime Capital Insights, where we break down finance in a simple, beginner-friendly way. In the last video, we talked about how to choose your first investment. And if you've reached that stage, you've probably heard two terms everywhere: index funds and ETFs. They sound similar. They're often recommended to beginners, but they're not the same. So which one should you choose as a beginner? In this video, I'll break down index funds versus ETFs, what they are, how they work, and which one might make more sense for you, without jargon, hype, or confusion. Disclaimer: before we continue, a quick reminder. This content is for educational purposes only and does not constitute personal financial advice. Always do your own research or consult a qualified professional before making financial decisions. Now, in the previous videos, we covered how to start investing as a beginner and how to choose your first investment. If you followed those steps, you've likely come across two popular options: index funds and ETFs. They're often mentioned together, but they work slightly differently. So in this video, we'll clearly break down what each one is and help you understand which might be a better fit for you as a beginner. What are index funds? Let's start with index funds. An index fund is a type of investment that simply follows or tracks a market index. A market index is just a group of companies that represents a part of the overall market. For example, large companies, technology companies, or the entire stock market. Instead of trying to pick winners, an index fund invests in all the companies in that index. Think of it like this: rather than betting on one company to succeed, you're investing in the performance of the entire group. That's why index funds are often recommended to beginners. They are simple, they are diversified, and they're designed for long-term investing. When you invest in an index fund, you're not trying to beat the market. You're choosing to grow with the market over time. This approach reduces the risk of making big mistakes early on, like buying the wrong stock or reacting emotionally to short-term market moves. Another important benefit of index funds is cost. Because index funds simply follow an index, they don't require constant buying and selling by managers. This usually means lower fees compared to actively managed funds. Lower fees may sound small, but over many years, they can make a big difference to your overall returns. Index funds are also easy to understand. You generally know what you're investing in, how it works, and what kind of long-term behavior to expect. For beginners, this simplicity is powerful. It allows you to focus on learning, staying consistent, and building good investing habits, instead of worrying about daily market noise. In short, index funds are designed to be steady, diversified, and beginner-friendly. They may not be exciting, but they're built to work quietly over time. And that's exactly what many beginners need. What are ETFs? Now let's talk about ETFs. ETF stands for Exchange Traded Fund. At a basic level, an ETF is very similar to an index fund. It also holds a collection of assets like stocks or bonds, and it often tracks a market index. So what's the difference? The key difference is how ETFs are bought and sold. ETFs trade on stock exchanges just like individual stocks. That means you can buy or sell an ETF during market hours, and its price can change throughout the day. Think of an ETF as a basket of investments that behaves like a single stock. Just like index funds, ETFs offer diversification. With one purchase, you can gain exposure to many companies at once. This helps reduce risk compared to investing in a single stock. ETFs are popular with beginners because they are flexible and transparent. You can see their prices in real time, you can start with small amounts, and many ETFs track broad markets, making them simple to understand. Another advantage of ETFs is cost. Like index funds, many ETFs have low fees because they follow an index rather than relying on active management. However, because ETFs trade like stocks, they can tempt beginners to overtrade, buying and selling too often based on short-term market movements. That's something to be careful about. ETFs are best used with a long-term mindset, just like index funds. When treated as long-term investments, they can be powerful tools for building wealth gradually and consistently. In summary, ETFs combine diversification with flexibility. They give beginners access to broad markets, low costs, and ease of use, as long as they're used with discipline and patience. Key differences: Index funds versus ETFs. Now that you understand what index funds and ETFs are, let's compare the key differences between them, simply and clearly. The first difference is how they are traded. Index funds are usually bought or sold once per day, after the market closes at a single price. ETFs, on the other hand, trade on the stock exchange throughout the day, just like stocks. The second difference is flexibility. With ETFs, you can see prices in real time and buy or sell during market hours. Index funds are more hands-off. You invest and let it work quietly in the background. The third difference is minimum investment. Some index funds may require a minimum amount to start, depending on the platform. ETFs often allow you to start with smaller amounts, sometimes even the price of a single unit. Another difference is behavior risk. Because ETFs trade like stocks, they can encourage frequent buying and selling. Index funds reduce this temptation, which can help beginners stay disciplined. Finally, when it comes to long-term returns, index funds and ETFs that track the same index usually perform very similarly. The difference isn't about performance, it's about how you invest. So the choice isn't about which one is better overall. It's about which one fits your style, comfort, and discipline. Which is better for beginners? So now we come to the most important question. Which is better for beginners? Index funds or ETFs? And the honest answer is not what most people expect. There is no universally best option. The best choice depends on how you behave as an investor, not just what the product is. Let's break this down clearly. If you're a beginner who wants a hands-off approach, index funds may be a better starting point. They're designed to be simple and boring, and that's actually a strength. You invest regularly, don't watch prices all day, and let time do the work. Index funds reduce the temptation to react emotionally. Since they're usually bought or sold once per day, they naturally encourage patience and long-term thinking. On the other hand, ETFs may be better for beginners who value flexibility. They allow you to start with smaller amounts, see prices in real time, and invest whenever markets are open. But that flexibility comes with responsibility. Because ETFs trade like stocks, they can tempt beginners to check prices constantly, buy on excitement, or sell during fear. And emotional decisions are one of the biggest reasons beginners struggle. So the real question isn't which product is better. The real question is which one helps you stay disciplined. If watching prices makes you anxious or impulsive, a more hands-off approach may protect you from yourself. If you can stay calm and disciplined, ETFs can work just as well. Another important point is this. Index funds and ETFs that track the same market often deliver very similar long-term results. The difference is rarely about returns. It's about behavior. Many beginners believe success comes from choosing the perfect investment. In reality, success comes from staying invested through market ups and downs. Consistency matters more than the choice between index funds and ETFs. Time in the market matters more than timing the market. So if you're just starting out, choose the option that feels simple, comfortable, and sustainable for you. You can always adjust later as your knowledge and confidence grow. Remember, the goal of your first investment isn't to be perfect. It's to build habits, experience, and trust in the process. And once you do that, you're already ahead of most people. Common beginner mistakes. Before we wrap up, let's talk about some common beginner mistakes, not to scare you, but to help you avoid them. The first mistake is overtrading. Because ETFs trade like stocks, beginners often feel the urge to buy and sell frequently. They react to news, price movements, or short-term market noise. Overtrading increases costs and usually hurts long-term results. The second mistake is chasing performance. Beginners often look for the fund that performed best last year and assume it will continue. But markets don't work that way. Yesterday's winners are not guaranteed to be tomorrow's winners. Another common mistake is ignoring fees and costs. Even small fees can compound over time and quietly reduce your returns. Beginners should always be aware of expense ratios and trading costs, especially when investing long-term. The fourth mistake is panicking during market downturns. Markets go up and down, that's normal. But many beginners sell during market drops because they mistake volatility for failure. This turns temporary losses into permanent ones. Another mistake is starting too aggressively. Some beginners take on more risk than they're comfortable with. Thinking higher risk means faster results. When markets move against them, stress and fear take over. And finally, a very common mistake is inconsistency. Investing once and then stopping, or investing only when markets feel good, breaks the power of compounding. All of these mistakes come from one place: emotion. Successful beginners don't eliminate emotion, but they learn to manage it. Avoiding these mistakes doesn't require complex strategies. It requires patience, discipline, and a long-term mindset. And if you focus on that, you're already doing better than most beginners. Simple decision checklist. To make this even simpler, let's put everything into a short decision checklist you can use right now. First, define your time horizon. Ask yourself, do I need this money in the short term, or is this for long-term growth? If it's long-term, both index funds and ETFs can work well. Second, check your behavior. Do you prefer a hands-off approach where you invest regularly and don't check prices often? That usually points toward index funds. If you're comfortable seeing prices move and can stay disciplined, ETFs may suit you. Third, look at your comfort with risk. If market ups and downs make you anxious, choose the option that feels calmer and easier to stick with. Comfort matters more than complexity. Fourth, consider simplicity. If you can clearly explain what you're investing in and why, you're on the right track. If it feels confusing, slow down. Simple is better for beginners. Fifth, focus on consistency. Ask yourself, which option will I realistically invest in regularly over time? Because consistency is what turns small investments into long-term results. If you can answer these 5 questions, you don't need expert predictions or perfect timing. You already have enough clarity to make a smart beginner decision. Remember, the goal isn't to choose the perfect investment. The goal is to choose one you can stick with. If this video helped you understand the difference between index funds and ETFs, take a moment to like the video and subscribe to Prime Capital Insights. This channel is focused on helping beginners build investing knowledge step by step, with clarity, not hype. In the next video, we'll talk about how to build your first simple investment portfolio, how many investments you need, how to balance risk, and how to keep it easy as a beginner. So stay tuned, and I'll see you in the next one.